Hey everyone, and welcome back to another video for today. So we have to talk a little bit about PayPal, why I do believe that this is still a no-brainer, why it might experience the same thing that we've seen with a Google or even with a SoFi, since that's also in the fintech space. Now you might think, what is this guy even talking about? Are you crazy? I know, it's a very different company, PayPal to Google and even PayPal to SoFi. SoFi is in growth mode, PayPal is not in growth mode, although it is growing, and yet the market is pricing it in as if it is not growing. I'm also going to show you two reverse DCFs, maybe even three. A DCF also from Emir, all of this in this video. I do think that right now PayPal, it's just sentiment not driving this stock up. It's sentiment driving this stock down, because there is no reason why PayPal today should be worth less than PayPal at the start of the year. PayPal at the start of the year was $91. I think today PayPal is a better company than it was at the start of the year. And yet, the market did drag this company down year to date by 20%. We're now at $65.4 billion in market cap. They're expected to buy back $6 billion worth of shares this year. The shareholder yield for the company sits at 11.1%. That's 11.1% return without any growth. It's quite something, right? It's quite something. Now you might say, yeah, but 11.1%, that's not much. But again, it is with zero growth here calculated. It's just the shareholder yield. It's incredible. And even right now, the market or the analysts are still expecting this company to grow. Compounded 5% revenue for the next 2 years. That's including the fiscal year that we're in right now, which is the lowest point, which means the next year we're going to see an acceleration in growth. But EPS is expected to grow double that. So 11.1% compounded for the next 2 years. Of course, from a PE standpoint, very, very cheap, whether it's forward or trailing. So let's talk a little bit about what the CFO has said yesterday. We didn't really get that much new information, but anyways, we have to go over the comments. If you enjoy this type of videos, hit all the buttons. I would also go over my option strategy with this one, because I did buy 2 call options, one for 26 and one for January 27. So we're going to go over that later in this video. Hit all the buttons, especially the notification bell, so you don't miss any of the future videos and especially live streams. And if you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so first up, the company does expect to exit the year with an accelerating growth profile. That I think will also be a catalyst here. Then profitable growth. The leadership team is encouraged and excited about the company's direction, noting progress in key areas like processing, value-added services, and Venmo's growth, right? Value-added services is the blue bar right here that has been growing quarter after quarter, also higher margins. I do believe that we're going to get a quarter where this is going to generate $1 billion in revenue. Then as for the Germany service disruption, the company acknowledged a temporary service disruption in Germany, but stated that the issue has been fixed and the financial impact is expected to be minimal. The cost will be absorbed within the existing guidance for the third quarter. So again, nothing changes here. Then comments about branded checkout. Branded checkout, which includes both PayPal and Venmo, is consistently growing at mid-single digit rate of 5 to 6% in terms of TPV. The company expects this growth rate to accelerate by the end of 2025 and into 2026. So we're probably not going to see the expected reacceleration in growth in Q3, but we might see it, and we'll probably see it in the guidance for Q4. A key initiative is migrating merchants to the latest branded checkout experience. This has reached 60% penetration in the United States and is in the mid-teens globally, with a target of 80% globally by 2027. The key growth drivers are 1. Buy now, pay later. This product is growing at a rate over 20% and is seen as a key tool for customer acquisition. We've talked about buy now, pay later more recently with regards to Sezzle, Affirm, Klarna is going public as well, Afterpay. All of them are seeing, of course, a lot of momentum. And now here with PayPal, you actually get a buy now, pay later business in PayPal. Then we have Venmo that is growing 45% and is a significant contributor due to its seamless mobile-first experience and, of course, extremely popular with the younger generation. As for the momentum for Venmo, management is just getting started with Venmo and it aims to sustain a 20% revenue growth rate over the next few years. This growth is being driven by new features like Venmo Groups, Venmo Debit Card, and new partnerships. As for Braintree, PayPal's unbranded processing platform, Braintree has delivered profitable contributions to transaction margin for 5 consecutive quarters. Of course, that came at a cost of the high growth that we've seen before. Its TPV growth is expected to accelerate to mid to high single digits by the end of 2025 and align with the broader e-commerce market growth in 2026. This is supported by the adoption of value-added services such as risk as a service and payouts. As for the financial outlook, the company has maintained its full-year guidance for transaction margin dollars, excluding float, at 6 to 7%. The guidance implies a slight deceleration in the second half of the year compared to the 7% growth seen in the first half. This is attributed to tougher year-over-year comparisons for credit products and a more cautious outlook on the broader e-commerce market. Now, of course, if the e-commerce market does not weaken or significantly weaken, then they could easily beat their own guidance, which has always been, since Alex Ries came in, has always been quite conservative. Now, my issue here with PayPal is that, one, if you're so excited about what's happening with the business now and with the business in the future, then I do think that you should accelerate the buybacks. You should be way more aggressive by buying back even more shares just to send the signal to investors and especially the market. We think our company is extremely undervalued right now, and that's why we are accelerating the buybacks. That's what Uber has done at the start of the year, right? Stock was extremely cheap. They just accelerated the buyback. I do think that that could send a very, very strong signal here to the market. Then, management. I know they are being conservative. I know they're still turning this huge company around. But I do think that it might be time, especially towards the end of this year, to be a bit more aggressive with the goals. It's fine at first when you come in, you change the team, you want to turn things around, to be a bit more conservative so it's easier for you to meet those goals. But at a certain point, of course, there will come a time where, okay, it's fine to be conservative, but maybe since you are excited, since you are telling us that, yeah, this is doing well, that is doing well, then maybe it's time to be a bit more aggressive with guidance. I do think that these things will come. Of course, I am still very bullish on the company. I've been bullish on the company for a while, but I was wrong on the timing. I did think that it could turn around sooner than expected. That did not happen. That does not mean that there is not a significant amount of upside in the future with PayPal. So yes, in hindsight, opportunity cost. But you cannot say opportunity cost at the moment because you don't know what's going to happen next, right? When the stock was at $90 at the start of the year, we're quite happy with the performance, right, over that short period of time. We didn't know that suddenly the market would say, actually, PayPal, even though at $90 it was still undervalued, actually it should be worth 20% less. You don't know that. So this opportunity cost excuse is only in hindsight. If we always knew that, oh, okay, if we buy this stock, we will underperform. And if we buy that stock, we will outperform. If we knew that, we would have been multi-millionaires, if not billionaires right now. But we don't have that crystal ball. With all that said, let's actually look at some numbers here. Let's actually do some reverse DCFs, and I'll show you also Emir's model. There is also going to be a link down in the description to his Substack. So PayPal's trailing 12 months free cash flow sits at $5.292 billion. For the year, they are expected to generate $6 to $7 billion in free cash flow. Terminal growth rate here, I put 4.15%. I'm basically taking the 10-year yield here. I'm going to show you the other scenario. Discount rate, 7.83%. How do I get that number? It's basically the terminal growth rate plus the implied risk premium of 3.68%. Now, if you look at this right here, you're like, oh, whoa, why is it at 0%? Well, yes, with 0% growth, currently, the intrinsic value, the estimated intrinsic value based on these numbers, is 33.2% higher than when we're at right now. Not bad, right? Even if PayPal will only grow 1%, stock should be 44.7% higher than when we're at right now. Now you might say, yeah, but that terminal growth rate doesn't make any sense. 4.15% doesn't make any sense. Well, I just take what the market is saying right now. But of course, you can do the other scenario. You can plug in the usual numbers, right? 82% and then a discount rate here of 10%. And we see that currently PayPal free cash flow will have to grow each and every year for the next 10 years by 4.3%. That's it. That's what it will have to do. Is that a lot or not? Well, again, if we look at what the current expectations are for fiscal 25, which is this one right here, again, the worst year out there, only 4.1% growth. But then fiscal 26, 5.9% growth, and then 6.6% growth in fiscal 2027. And I'm not even sure if analysts are calculating advertising, the advertising business in those estimates. So we are going to see, or that's the expectations, that the revenue growth is going to accelerate above 5%, quite close to 6%, fiscal 26, fiscal 27. Now, quickly looking at this, I've shown you this with other companies as well. If you look at the stock price and net income, what we've seen before is that the stock does follow net income, right? On the way up and also on the way down. But what has happened over the past 3 years is that net income did recover and we're making our way to all-time highs, yet the stock has not moved over the last 3 years. Quite interesting, no? There will come a time, it's not a question of if that will happen, it's just a question of when the market will suddenly realize, oh, actually there is some catching up to do here. We've seen the same thing with Google, for example. This was a post I made back in June. You can see that with Google, same thing. Stock price does follow net income. Well, it did not follow net income more recently. And so stock usually follows net income. It's only a matter of time. Guess what? The stock did follow net income. But of course, I know PayPal is not Google. Google is not PayPal. But when we talk about sentiment, when we talk about catalysts, tailwinds, headwinds for the market, there are a lot of similarities. Now let's have a quick look at Emir's reverse DCF. This was made a month or so ago, so the discount rate, terminal growth rate, implied risk premium are a bit different to the ones that we're using today. But this reverse DCF, again, also assumes 0% growth. And back then, the upside was 30.27%. In this one, it's even better. It's a negative 3.33% growth assumption from here. Also, again, implied risk premium, risk-free rate, and all of that is a bit different to the one that we're using today. And here the upside is 0%. So not only is the market, or was the market pricing this in as a 0% growth story, but it's pricing it in as a negative growth story. And we know that PayPal is growing. Now, he did also make a DCF, not a reverse DCF. And these are his assumptions in order to reach the intrinsic value based on, of course, the story that he's telling us right here, with 103% upside from the price it was a month ago, which is basically the price we're at right now. What we're seeing here is, of course, expectations for an acceleration in growth for 2026 because of the weak year-over-year comparisons, and then a more normalized growth rate, whether it's TPV growth or PayPal's revenue growth over the following 8 years. Looking at operating margin, we do see that improve a little bit, 18.2% right now, fiscal 25, 18.8 fiscal 26, and then growing to 20% by 2030 and staying at 20%. As for free cash flow margin, we go from 13.6% in fiscal year 25. Last year was 16%, but there was that one-time impact, I do believe. And that should recover in 26 and stay around 17 to 18% from here on out. And that's how you're reaching an intrinsic value of 136.6%. Of course, these assumptions can change. Whoever is making the DCF will have another story to tell. But what's very clear here is that PayPal is extremely undervalued. Now, it's been undervalued for quite a while, and the market, of course, does decide whenever it turns a page, right? We've seen that with SoFi as well. SoFi was trading between $6 to $10 for 2 years or so, while the business kept on executing. Even until last year, SoFi didn't really move that much. This year, there was a a couple of months or so where SoFi was down, and then suddenly the market turned that page and said, actually, there is quite a good business here. There's a business that's actually growing, becoming more profitable, and becoming stronger and stronger as well. And suddenly we see the stock jump quite rapidly. I do think we can see the same thing here with PayPal, but of course, there needs to be some patience. Then as for the options play, I chose one here, $100 March 2026 call options, and this is the potential upside or downside from here on out. So I do still own shares, but I did reduce the share position in order to buy options because, well, as you can see, the upside here, if I'm correct, is of course much, much higher. But of course, there is a risk of me losing it all. That's a risk that will not happen by holding shares. The upside here is, of course, immense. The downside is 100% if, of course, we're not at $100 by the March date. Same thing here with the January 2027 call options that I have, $120 here as well. The upside is quite big, and here I am, of course, giving them a long period of time. With March, I'm giving them basically 2 quarterly earnings call, also giving them the guidance for 2026, and probably also 2 rate cuts in order for the stock to go back to triple digits. With, of course, the 2027, I'm giving them a lot of time. And I would be very, very surprised if PayPal is not at triple digits in 2026. And so all in all, that's about it for me in this video. Yes, it is, of course, frustrating holding PayPal, holding something that you know is undervalued and seeing the market go up significantly while you're still stuck at the same price. It is very, very frustrating. I completely understand that. But there will come a time, just like with every other company out there that is growing, that is becoming more profitable, that is buying back a ton of shares. There will come a time when the market will realize, and then I do think that the stock will move very, very fast on the way up. Yes, you can have a year or two of underperformance, but I do believe that PayPal will reach all-time highs over the next 5 years because it's going to be easier to reach that all-time highs stock price-wise with, of course, less shares on the public markets. And again, we are not talking even about the advertising business, which could generate them billions of dollars in revenue, high margin dollars. So long story short, still very bullish on PayPal. I did change the strategy a little bit. I know very well that call options are much riskier than just holding shares, but that's the risk I am willing to take. That's about it for me in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I see you all in the next one. Bye-bye.